Hi, John Rapasky from the Counsel Mortgage Group. I received some questions from you recently, so I thought I'd take the time to answer these for you. One question came in, said, can you transfer a mortgage to someone else? That's a great question, and that's a question we don't get all that often. And the answer is, it depends. I mean, what you're asking is whether I can assume a mortgage. In other words, if I have a home and I'm at 3.5%, and the current rates are at 4 or 5, can I get your mortgage? And in fact, we're probably going to get a lot of those questions as we go on here in the next few years, because that's exactly what happened. A lot of people in the last couple of years ended up getting some great rates, and they're going to say, I want that mortgage. Well, FHA loans are assumable. So if the person that's selling a house has an FHA loan, you would, when you purchase the home, apply through their lender to see if you can get that assumption of that loan. Other than that, there aren't many loans out there that are assumable. You'd have to check the note in the deed of trust. But for the most part, most loans are not assumable, so they wouldn't be transferred. Here's another question. Can you sell your house on an outstanding mortgage? The answer is yes. What would happen is, when you sell the house, so let's say the mortgage balance is $150,000, you sell the house for $200,000. When you sell the house, the mortgage will get paid off right then and there, so the lender gets their $150,000, and then you make $50,000 profit. A bigger question is what happens if your house is upside down. So let's say that the house is worth $200,000, but your loan is $225,000. So you're $25,000 upside down. What happens then? Well, we've just gone through this over the last few years. And a lot of folks try to get a short sale. In other words, they'd go back to the bank and say, hey, will you forgive the $25,000 and allow me to sell the home at $200,000? And they'd try to get a release from the bank, from the lender on their note, so then they can sell the home. And the other banks said no. And then they just let the loan go, and then they foreclosed. So that's what happens to your mortgage. If it was a short sale, or if you sold for less than the loan balance, there could be tax consequences. So you have to make sure you talk to your tax accountant. May not be bad if you're upside down to talk to a real estate attorney as well. Next question that came in is, how much of a mortgage can I get based on my salary? Well, there's a couple things that go into that. First of all, if you are salaried, well, then you can just kind of take the typical debt-to-income ratio. You take a look at your monthly debts, compare them to your monthly income, and if you're about 45, as a general rule, if you're 45% or less, you'll probably be okay. But how's salary calculated? Well, if you're a W-2 employee and you make a salary every year, fine. If you're a commissioned employee, lenders are going to want to see typically they're going to want to see a 2-year history of commissions. And then they're going to subtract out your expenses to figure out what your income is. If you're self-employed, they're going to take the net income on your tax returns and then use that divided by 12 months and determine what your income is. So there are little tricks there, but typically what you're looking for as a general rule is a debt-to-income ratio of about 45% or less. If you have any other questions you'd like to submit, be happy to answer them. Go ahead to our website, www.counselmortgage.com, or give us a call, 480-502-1000. Thanks.